What's up, everybody? Carlos here. Welcome to another edition of the Free Toaster News Pod. I'm here recording on July 2nd and wanted to wish you all a happy 4th of July weekend. I'm going to be here, believe it or not, mostly trying to avoid the crazy here in DC. I live right outside the city and it's just been nuts with like airports closing and all sorts of stuff going on the mall. As much as I want to see the kind of the blown out fireworks display, it's starting at 10:30. I have two young kids, and if I actually went down there to watch it, I'd probably be home at like 1 in the morning. So I think I'm gonna hard pass on that. There's local fireworks actually going on tonight, which I'm gonna go check out. If you're familiar with the area, it'll be in Vienna, Virginia, which is a bit of a drive from us, but not too far. So anyways, that's our plan for this weekend. Before I get into the news, as you can probably tell, I'm flying solo today. So Nick is out with his family. I believe he's out in Oregon, and I'm recording this week solo. Before we get into the news, I want to drop a mention just to thank our sponsors, Bulldog Media Group, Fintel Connect, and Spinwheel. They've been behind us from the very early days, supporting our publication and now our pod. Also want to mention our event that's coming up September 23rd. I've had, I think, about 30 people officially register, 60 people, or 30 people in addition, so 60 total, who've told me either through an email or through a text that they're coming. And there's only 150 seats, so this thing's starting to fill up, which I'm excited to see. If this is interesting to you, we're pulling together consumer lending companies and publishers in the space. Companies like Experian, Credit Karma, Engine. By the way, Experian and Engine are sponsoring the event. So they're sending a few folks. And if you're interested in knowing who's coming, what logos have already registered, and kind of the high-level agenda, check us out at events.thefreetoaster.com. We actually just redesigned the website, and I really hope to see you there and meet you in person. All right, so today's news story, we're going to be talking about Lending Club. If you've been following our news editions, you already know that they rebranded to Happen. So the story here is, what are they doing? Like, what's behind this rebrand? So let's get into it. I'm gonna summarize this week's newsletter piece. So last Tuesday, Scott Sandberg rang the NASDAQ opening bell, and Lending Club officially ended. So the company now trades as Happen Inc. under the ticker HAPN. And they just completed that full rebrand to Happen Bank. And they actually changed from the NYSE to the NASDAQ. So I'm not sure the details behind that, but American Banker covered it, and you can check that out. We linked to it in the article. We originally covered this announcement in April. So you might be wondering why we came back to cover it again, now that it's not so new and fresh. And we think there's an interesting story here layered underneath that rebrand. So we think it's a clean example of a lender picking a customer segment first and then engineering every product, reward, dollar of funding around that user in that segment. So if you market lending or deposit products, which I know a lot of our audience does, we think this is worth a few minutes to unpack. So first, what happened to Lending Club? So first of all, they're, just to give you an idea of the scale here, 5 million plus lifetime vendors from Lending Club and now Happen, and $100 billion plus in lifetime originations. We sourced that from a 2025 10K that they filed. So you may remember Lending Club as the P2P lending pioneer. That company hasn't existed for a long time. I remember I was at Capital One during these days. Remember originally hearing about Lending Club. And actually, I think I even logged in, created an account, and started to look at what it might feel like to actually invest in one of those loans. So they were offering these really high yields as a saver. And then the model was they would pair the investor/saver to the borrower, effectively taking out the middleman, quote unquote. That it didn't end up being their destination business model. Today, they're a nationally chartered bank running a marketplace model with two core revenue engines. The first is balance sheet lending, pretty standard for lenders. Deposit funded loans are held for investment, and then they generate net interest income. And then the second is a marketplace. So they originate loans, sell them to investors, collect origination fees, servicing fees, and then gains on the sales of that capital light fee income. So loan book is overwhelmingly consumer today. Unsecured personal loans, think like debt consolidation, I think is a core. They also do auto refinance, point of sale financing, and a newly launched home improvement vertical. They also have a small commercial book focusing primarily on small business, or what they're calling SBA lending, while existing commercial real estate loans and equipment leases have ceased originations and are being retained to maturity. So in Q1, their originations were split roughly down the middle. 52% sold to marketplaces, marketplace investors, and 48% retained on book. So this matters for the strategy we're going to talk about below. Both engines get stronger when the same borrower gets cheaper to fund and safer to underwrite. So we're showing a graphic here in the newsletter, which I'll describe. Total originations in Q1 2026 were close to $2.7 billion, plus 31% year over year. 1.4 of that sold to via wholesale through what they are calling the structured certificates program, and then 1.3 of that retained held for sale, extended seasoning loans, and retained held for investment loans. So strategically here, they're focusing on what they're calling the motivated middle. So in their own words, they're a bank built for high FICO, high income, digitally savvy consumers actively managing their financial lives. So not the underbanked, not private banking clients. So they're somewhere in between. So prime borrowers who actively still borrow and use credit. So they're describing this, again, another graphic. You can check it out in the newsletter at thefreetoaster.com. So they're saying this is 32% of the US adult population, tens of millions of consumers who are goal-oriented, digitally capable, value conscious, multi-relationship. I assume this means hold multiple relationships with one banking institution, average FICO at 717. And the US pop, the lending club members have an average FICO of 719. And then income, US adult population averages 75. And then the lending club members skew a little bit higher at 121. So a little bit more affluent than average. And then if we look around the industry, we'll notice why this was open to them. So Chime and Dave and other neobanks built their businesses on low to moderate income consumers. They were doing things like overdraft protection, early wage access, interchange fund economics. SoFi took a bit of a different take with high earners with their student loan refi, and then wealth management, premium life cycle branding, and then the big banks, so companies like Chase and Citi, B of A, they're sitting on trillions in near zero cost deposits, but they don't always succeed in securing the customer's lending business. So this person with a 720 or 740 FICO who carries a 25K consolidation loan and has a real savings balance that doesn't appear to be anyone's target, happen is planting their flag there. So the sequencing question here, we think this is kind of like Chime in reverse. Chime did the hardest thing, we think, in banking. So they won the direct deposit relationship and then expanded out into credit. Happen seems to be running the opposite play. And it's the same one we've seen from SoFi and some of the big banks. So lend first, because that's where the net income and money tends to be in financial services. And frankly, because many organizations have an easier time getting lending licenses than bank charters. That may be changing these days as you see lots of bank charters flying around, but at least historically that's been the case. And then they use the loan relationship to earn their way into deposits and checking. So the loan first approach seems more logical from the profitability sense, but it leaves Happen with this challenge because they don't own the primary banking relationship. They're trying to get it, but that deposit market's really crowded. Which distribution channels it will pick, how it'll close that gap, it'll be something we're watching over the next few quarters. Another interesting thing to note here is the flywheel they're attempting to build and how they design their products. So these are going to be rewards that pay for behaviors. not balances. So like, let's make this more concrete. So they have 2 deposit products, and we think they're engineered so that every reward dollar buys a behavior that improves their own bottom line. So they have a product called Level Up Savings. This was launched in August 24. It pays a higher APY. Currently it's 4% for members who deposit at least $250 every month. And then if you read the fine print, that this drops to 3% if you don't. But they're incentivizing that continuous savings behavior, which builds the balance over time, obviously. They say they have 80,000 accounts, 3.5 billion in deposits, and that these savings customers visit 30% more often than the prior product. I assume they're referring to another deposit product that came before this. So that's the savings, Level Up Savings. Level Up Checking launched more recently, June of last year in 25. That pays 2% cash back on-time personal loan payments made from the account, plus 1% back on gas, grocery, pharmacy, debit purchases. So this is interesting. It's pulling in low-cost deposits, moving the loan servicing inside their ecosystem, and paying the borrower to do the very thing that keeps charge-offs down, which is on-time payments. So since launch, account openings are running at 6x the prior checking product, and 60% of accounts are coming from existing members. So the cross-sell here is seemingly working. But there's a number that left us scratching our heads a little bit. So that they disclosed 70% of Level Up savings holders, which represent 95% of all balances, hit that $250 monthly threshold. But they invite some basic math here. 95% of 3.5 billion spread across 70% of their 80,000 accounts. So that works out to an average balance near $59,000 among these threshold meeting savers, these folks that deposit $250 monthly. And they disclose these figures March 30th this year. So there's not a mass market audience. So we're talking about an affluent saver earning 4%, which raises a question. Why is this customer with $59,000 in their saving account taking out personal loans with Happen? So either the savings and the borrowers are different pockets of the member base, or the prime borrower or the prime saver who still borrows is wealthier than that debt consolidation stereotype maybe suggests. So a few things to consider here as we wrap up this story. So one, this rewards program seems thoughtfully designed for the audience and for their P&L. So they're incentivizing these payments that tie back to P&L, that reward, that the 2% cash back for on-time personal loan payments. That's really interesting. I don't think I've seen that before, but super smart. I can see why they're doing that. Second, I actually don't expect the deposit business will reduce CAC. It actually may raise the CAC they can afford. So when 60% of new checking accounts come from existing borrowers, that lifetime value of a new customer for a loan product goes up, and that's going to let them bid more for media and buy growth at the margin. So the Fortune 500 banks of the world, they're happy to push up their CAC as long as they think they're getting a profit on the margin, especially in paid channels like paid search and direct mail. So the question for Happen is what will the next 2 quarters of marketing spend look like? What will that show? Will they try to drive up their volumes and their CACs now that they understand this relationship between the economics across these products? And then the metrics we want to understand better as we dig into the story over time are their checking account volumes. They gave us the number of savings accounts that they have today. They didn't share checking, and we're wondering why. Their cross-sell rates, blended CACs. Until then, we have open questions. So how many of those affluent savers came from the loan base versus straight rate shopping on that 4% APY? And does the flywheel actually convert borrowers into primary banking relationships or just high yield deposits? So summarizing their bet, it seems to us that their most overlooked consumer and consumer finance is that prime saver who still borrows, and Happen is betting that they can win them by incentivizing them, paying them to behave in ways that improve the deposit base, their loss curves, and the cross-sell rates all at once. So only time will tell, and the proof will show up, the CAC, the cross-sell success rates, the growth of their member base over time. So we're excited to watch this story. If this is a story you have a perspective on and you'd like to discuss this with us in a future news pod, please reach out to me. You can find me at carlos@thefreetoaster.com. And that'll be a wrap for this week. Again, I hope you enjoy the festivities this weekend for the 4th of July, and we'll see you here next week.